Welcome back to Investing Talk Podcast.
Great to be back.
Today we're unpacking Progressive. You know them, PGR. If you drive, you've seen the ads. They're just one of the absolute giants in car insurance.
Definitely a household name.
And our goal here is to cut through all the noise, pull out the key insights from, well, the information we've gathered. We want to get a clear picture of where Progressive stands, say, middle of 2025.
Looking at the recent financials, their spot in the market.
And, the risks, the opportunities based on what we're seeing. Think of it as your quick way to get up to speed on this major player.
It's a particularly interesting time to look at Progressive, wouldn't you say? The whole insurance sector's seen some turbulence.
For sure.
Yet Progressive seems to be navigating it, well, pretty effectively. They've certainly caught the market's eye lately.
Okay, before we jump in, if you find these deep dives valuable, if this helps you stay informed, please take a second now. Subscribe to the channel, like this content, maybe drop a comment with your thoughts.
And if you're feeling generous, consider buying us a coffee. It really helps support the show.
It does. Okay, let's get started. The engine room. Financials. What are the headline numbers telling us about their recent performance? Some of these figures seem pretty striking for a company this size.
They really are. I mean, look at the scale first. We're seeing estimates that Progressive's full year 2025 revenue might hit $86.06 billion. That's huge.
$86 billion. Okay.
But what really stands out is the growth rate. As of April 2025, revenue was up 21.36% compared to the year before. That's described as a, quote, robust acceleration.
21% growth
Right.
on that kind of base. That's substantial momentum. And what about the specifics for, say, April? The premiums.
Good question. So in April alone, net premiums written were up 11% year over year, but net premiums earned jumped even more, up 19%.
19% earned premiums growth in a month, year over year.
And this isn't just, a recent fluke. The material indicates Progressive has shown pretty consistent top-line growth over the last, say, 3 to 5 years.
And where's that coming from? More customers, pricing.
It seems to be both, fundamentally.
Right.
Policy growth has been strong, and they've clearly been active on the pricing front.
Right, more policies, higher prices, feeding that top line. What about the bottom line then? Earnings per share, EPS?
Also looking quite compelling, the estimate for the full year 2025 is around $16.09 per share.
Okay.
But look at April 2025 specifically. Reported EPS was $1.68. Now, compare that to April 2024, it was just 71 cents.
Wow, 71 cents, $20.68. That's more than double year over year for the month.
Over 130% growth, yeah. A really sharp rise for that particular month.
So that kind of revenue acceleration and that level of monthly EPS growth, what does that really signal for a company like Progressive? What's the takeaway?
Well, it suggests they're executing really well operationally. Their model seems to be translating that top-line growth into profit very efficiently right now.
Okay.
That premium growth, especially the earned premiums, lines up with a big jump in total policies. We're seeing policy count up 17% year over year. They're now over, 36 million policies?
36 million. Huge base.
So getting customers, earning more from them, that drives the revenue. And that EPS surge, it shows the costs aren't eating up the growth. It's flowing through, meaning they're growing profitably.
And profitability in insurance, that always brings us to the combined ratio. You mentioned a number there that sounds, pretty remarkable.
Ah, yes, the combined ratio, absolutely crucial metric. And this is where Progressive seems to be really standing out from the pack. The information points to a recent combined ratio around 85%.
85.
Specifically, 84.9% was mentioned, and that's down significantly, over 400 basis points from the previous year. It's explicitly called best in class.
Best in class. Okay, that definitely catches the ear. For anyone maybe less familiar, can you just quickly break down what that means? Why is 85% so good, especially if competitors are struggling near or even over 100%?
Think of it simply. It's the ratio of costs claims paid out plus operating expenses to the premiums they actually earned. Below 100% means you're making money just from underwriting insurance.
Okay, so lower is better.
Much better. And 85% is exceptionally strong. It signals really tight underwriting discipline. They're good at picking risks and pricing them right. Plus, it shows operational efficiency.
So they're making a 15% margin on the insurance itself before investments.
That's the idea. When others are maybe around 95% or even 100% or more, meaning they might be losing money on the core business, Progressive's 85% shows a really strong, profitable insurance operation.
Okay, that paints a picture of strong growth Impressive profitability. So how are they doing it? What are the core strengths, the advantages that are driving this performance, according to the material?
Several key things pop out. First, simple, powerful brand recognition. They're just very well known.
Hard to miss them.
But beyond that, a huge advantage cited is their data-driven approach. Sophisticated pricing models, heavily leveraging telematics.
Telematics, that's the tracking driving behavior, right? The
Yeah.
snapshot program and things like that.
That's the one. This gives them a massive data advantage. They can price policies with much more precision based on actual driving risk. And it lets them adapt really quickly to changing conditions because they have that real-time data flowing in.
Makes sense. Faster feedback loop.
Plus, the material notes their history of innovation. Being first with phone sales, first with online policy purchases, it suggests a culture that's comfortable using technology for efficiency and customer reach.
So, strong brand, big data edge through telematics, history of tech innovation. Where does that put them in the market overall?
They're holding steady as the #2 personal auto insurer in the U.S., right behind State Farm.
Still number 2?
But they're not just auto. Big presence in commercial auto, too. Motorcycle, boat, even homeowners insurance now.
Yeah.
And crucially, the analysis suggests they are actively taking market share from competitors.
Gaining share. Why? What's attributed to that?
Superior segmentation, being better at identifying profitable customer groups and pricing for them effectively. And also efficient claims handling, as mentioned.
Okay, let's tie this back. We talked about the strong growth, the great combined ratio. How do these strengths, the brand, the data, the innovation, actually translate into those numbers?
It really seems like a positive feedback loop. That data edge from telematics directly fuels better underwriting. Understanding risk better lets them price policies more accurately, which is key to achieving that, stellar 85% combined ratio.
Right. Better pricing attracts the right customers or prices risk appropriately.
Exactly. It lets them price competitively for good drivers, accurately for riskier ones, which helps drive that policy growth to 17% jump without killing profitability. And things like strong online channels help bring in those 36 million plus policies efficiently.
Understood. So it's the mix. Scale, data smarts, disciplined underwriting, that seems to be the engine allowing them to grow fast and be highly profitable, setting them apart.
That appears to be the picture painted by the material, yes.
But, no business operates in a bubble. There are always challenges. What about the risks? What potential headwinds does this analysis point out for Progressive?
There are definitely risks highlighted, many inherent to insurance, but perhaps amplified now. A big one is regulation. Insurance is state-regulated very heavily, and the material specifically mentions regulatory scrutiny over pricing practices.
So getting rate increases approved when costs go up might face pushback.
That's often the concern. It can impact how quickly they can adjust pricing to match claim trends. Then there's the constant need for tech investment. The landscape keeps changing. You have to keep spending to stay ahead.
Always an arms race there.
And a really big one, increasingly impacting the whole sector. Rising claims from severe weather. More frequent, more intense storms, wildfires, floods, linked to climate change. That puts pressure on margins if pricing doesn't keep up.
That's a huge unknown. The weather impact. What else?
Macro factors, too. Think about interest rates. Changes there affect the investment income insurers earn on their reserves. And of course, competition. It's fierce, not just State Farm and Geico, but newer insurtechs trying to disrupt things.
Okay, quite a list. Regulation, tech costs, weather, macro, competition. But given Progressive's strengths in data and adapting quickly, how serious are these? Are they existential threats or more like ongoing challenges they might be better equipped for than others?
Oh, they're definitely significant risks for any insurer, Progressive included. Regulation is just part of the business, shaping everything. Weather losses are a massive, growing issue for the whole P&C sector. Even with good data, major catastrophes hit hard.
Right. Data helps predict, but doesn't stop the hurricane.
Precisely. And competition keeps everyone on their toes. So while Progressive's data and innovation might give them an edge in managing these risks compared to some, they are absolutely real headwinds. They require constant attention and could definitely squeeze results if things go wrong. They're major industry challenges, full stop.
Understood. So let's pivot to the market's view. How are investors and analysts reacting to Progressives, considering this performance but also these industry challenges? What's the sentiment? Stock movement?
The market seems to have reacted positively, at least recently. The material notes the stock closed recently at $268.42, up over $5 on that particular day, June 12th.
Okay, recent strength.
And this uptick is linked directly to positive momentum following recent earnings releases. It explicitly says investors responded favorably to continued strong financial performance.
So the strong results we talked about are seemingly getting noticed and rewarded in the short term. What about the broader view? Analysts, big money investors like hedge funds.
Analysts' sentiment is described as constructive. Generally, that's positive. They see the market share gains, the profitability as good signs.
Constructive.
Yeah.
So positive, but maybe not like wildly bullish.
That's often how you read it, yes. Solid fundamentals, likely to perform well. But there's an interesting note about hedge funds. End of Q1, fewer funds held Progressive 91 portfolios versus 100 the prior quarter.
Fewer hedge funds despite the good numbers. What's the thinking there?
The material suggests it might be a rotation. Maybe some funds are moving capital out of traditional sectors like insurance, even well-performing ones, and chasing perceived higher growth elsewhere. AI was mentioned as an example sector.
So it might not be about Progressive specifically, but about sector allocation trends, chasing the hot new thing.
That could be part of it. While Progressive is excelling in insurance, managers look across the whole market. If they see huge potential, rightly or wrongly, in AI or something else, they might shift funds, even from a solid performer like Progressive. It's about relative opportunity across everything.
That makes sense. It's not always a direct judgment on the company itself. What about buzz online, social media?
Social sentiment. Places like X or Reddit apparently seems generally positive following the recent earnings. People are picking up on the growth, the underwriting discipline. No credible negative rumors seem to be circulating.
So Main Street or online sentiment reflecting those strong core numbers. Did the material touch on valuation metrics,
Yeah.
PE ratio, things like that?
Briefly, it suggested the price-to-earnings ratio is likely mid-teens, maybe a bit above the industry average, which often happens with companies showing better growth and profitability. It also mentioned a history of strong double-digit return on equity, ROE.
Okay, and dividend.
Modest, historically noted around 0.3% to 0.6% yield. But it also specifically pointed out that details on things like debt to equity, free cash flow, price to book, beta, those weren't in this particular set of materials. You'd need to look at official filings for those.
Got it. So pulling this all together then, looking at Progressive through the lens of this material, what's the overall snapshot for mid-2025? Strong growth, clear data advantages, but those real industry risks looming.
Based on everything we've discussed from this material, Progressive seems to be riding a wave of strong operational momentum right now. They appear to be using their core strengths, especially data analytics and underwriting focus, to really outperform many competitors.
The results back that up.
Absolutely. The recent financials show they're expanding rapidly and doing it profitably. Policy growth is strong, and that combined ratio is, well, exceptional in the current environment. The market seems to be recognizing this, judging by recent stock action and analyst tone.
And there's something specific coming up soon to keep an eye on.
Correct. The material highlights the next earnings release is scheduled very soon. They'll report May's results on June 18th. That will give us the next data point on whether these strong trends are continuing into the second half of the year.
June 18th.
Yeah.
Okay, good to know. So, as a final thought for you listening, something to chew on after hearing all this, we've seen how critical data and technology are to Progressive's edge right now.
Definitely core to their success.
So, thinking ahead, what future tech shifts, maybe beyond today's telematics or the AI they're already using for pricing, what could be the next big thing? Could it be a huge opportunity for Progressive to extend their lead even further? Or could it be a major challenge, something that disrupts the very advantages they have now?
That's a really interesting question to ponder. The tech landscape changes so fast.
Indeed. All right, that wraps up our look at Progressive based on the material we had. Thanks for joining us for this deep dive.
Hope it gave you a clearer picture. We'll catch you on the next one.